More than 100,000 jobs disappeared, housing sales collapsed in major cities, and billions of dollars in property value evaporated in what felt like a blink. Let that sink in. Entire construction sites went silent. Real estate offices that once buzzed with bidding wars are now eerily quiet. How does something that looked unstoppable just months ago suddenly slam into reverse? And here's the bigger question. Is this just a slowdown or the beginning of something far more serious? For years, Canada's housing market felt bulletproof. Prices soared. Investors rushed in. Homes sold in days, sometimes hours. People believed real estate only went one direction, up. But beneath the surface, cracks were forming. Rising interest rates, record household debt, and policy shifts were quietly building pressure, like steam inside a sealed container. Then suddenly the pressure released. In this video, we're breaking down the 10 powerful reasons behind Canada's housing explosion and why what happens next could impact everyone, whether you own a home or not. Number 1, sky-high interest rates. For years, money was cheap. Borrowing felt easy. Mortgage rates were sitting at historic lows, and buyers stretched their budgets because monthly payments looked manageable. But then everything changed. In one of the fastest tightening cycles in decades, interest rates surged, and the impact was immediate and brutal. Here's what that really means in simple terms. A family approved for a $700,000 mortgage at 2% could suddenly only afford around $550,000 at 6%. That's not a small adjustment. That's a massive drop in purchasing power. Almost overnight, thousands of buyers were priced out of the market. Demand didn't slowly cool, it froze. And housing is extremely sensitive to interest rates. Even a small increase can ripple across the entire economy. Higher rates don't just affect new buyers, they hit variable rate mortgage holders instantly. Monthly payments spike, budgets tighten, discretionary spending disappears. When households start cutting back, other industries feel it too. Retail, services, renovation companies, even restaurants near construction zones. This is where the job losses begin. When fewer people qualify for mortgages, fewer homes are built. When fewer homes are built, construction slows. When construction slows, workers are laid off. It's a chain reaction. What makes this even more intense is timing. Many homeowners locked in ultra-low rates during the pandemic. Now, as renewals approach at much higher rates, millions are bracing for payment shocks. Imagine opening a letter and realizing your mortgage is about to jump by thousands per month. That's the power of rising interest rates. They don't whisper, they hit hard. And for Canada's housing market, this was the spark that lit the fuse. If this breakdown opened your eyes, don't just watch silently. Join the conversation. Drop a comment below and tell us, are you seeing these changes in your city? Are you worried, or do you think this is a buying opportunity? Your perspective matters. Number 2, mortgage renewal shock. If rising interest rates were the spark, then mortgage renewals are the slow-burning fuse making this crisis even more intense. During 2020 and 2021, millions of Canadians locked in ultra-low fixed rates, some below 2%. At the time, it felt like a smart move. Payments were manageable. Budgets felt stable. Confidence was high. But here's the problem. Those ultra-low rates were temporary. Now, as those 5-year terms expire, homeowners are facing a completely different reality. Instead of renewing at 2%, many are staring at rates closer to 5%, 6%, or even higher. That can mean hundreds, sometimes thousands of dollars more per month. Not because they borrowed more, not because they moved, but simply because time ran out. Imagine budgeting your life around a $2,200 mortgage payment, and suddenly it jumps to $3,400. Vacations disappear, dining out stops, savings shrink. And in more extreme cases, families are forced to consider selling. This is what experts call a payment shock, and it's hitting in waves. Unlike an immediate crash, this pressure builds gradually as more mortgages come up for renewal each month. It's like watching dominoes fall in slow motion. And here's where it connects back to the job losses. When households redirect huge portions of their income toward mortgage payments, they spend less elsewhere. Retail sales drop, home renovations slow. These small businesses feel the squeeze. The housing market doesn't exist in isolation. It's deeply connected to the broader economy. Mortgage renewal shock isn't loud. It doesn't make dramatic headlines every day. But quietly, steadily, it's tightening the financial pressure on millions and adding fuel to Canada's housing uncertainty. If you've made it this far, you clearly care about understanding what's really happening beneath the headlines. So now I want to hear from you. Not just a quick yes or no, but your real experience. Are you facing a mortgage renewal soon? Have your payments already changed? Or do you think the worst is still ahead? Share your story in the comments. Your insight might help someone else realize they're not alone. Number 3, construction industry collapse. When most people think about a housing slowdown, they picture falling home prices. But what many don't see is the quiet crisis unfolding behind the scenes. The construction industry collapse. During the housing boom, cranes dominated city skylines. New condo towers rose every month. Subdivisions expanded rapidly. Builders couldn't keep up with demand. Contractors were booked out for months. Skilled trades were in short supply. It felt unstoppable. But housing is driven by confidence. And when buyer demand suddenly weakens, developers hit the brakes. Fast. New projects get delayed. Pre-construction sales slow down. Financing becomes harder to secure. And when developers can't guarantee profits, they pause or cancel entire projects. That means fewer housing starts, fewer permits, fewer groundbreaking ceremonies. And here's where it hits hard. Construction employs hundreds of thousands of workers, from carpenters and electricians to architects, engineers, truck drivers, and material suppliers. When projects stall, jobs disappear quickly. Not gradually, not softly, quickly. One canceled condo tower doesn't just affect the developer. It impacts the steel supplier, the concrete company, the window manufacturer, and even nearby local businesses that relied on workers grabbing coffee or lunch daily. And this is why housing downturns often lead to sharp employment losses. Construction is one of the most economically sensitive industries. It expands aggressively during booms and contracts just as aggressively during slowdowns. And because real estate plays such a massive role in Canada's economy, when construction weakens, the ripple effects spread nationwide. The cranes coming down aren't just a visual change in the skyline, they're a signal. A warning sign that economic momentum is shifting and that the housing explosion is leaving deeper scars than many expected. If this gave you a clearer picture of what's happening behind the scenes, don't just scroll away. Drop a comment and tell us. Are you seeing fewer construction projects in your area? Are cranes disappearing from your skyline? Or are things still booming where you live? Your local insight helps build a bigger national picture. Number 4. Foreign investment pullback. For years, foreign capital played a quiet but powerful role in Canada's housing boom. International buyers viewed Canadian real estate as stable, secure, and almost guaranteed to appreciate. Cities became global investment hubs. Luxury condos sold to overseas investors before locals even had a chance to tour them. But that momentum didn't last. In response to rising affordability concerns, policymakers introduced foreign buyer taxes, stricter regulations, and even temporary bans. The goal was clear: cool speculation and give local buyers a better shot. On paper, it sounded reasonable. But here's the unintended consequence. When foreign investment slows dramatically, a major source of demand disappears. In high-priced markets especially, that demand supported new developments, pre-construction financing, and large-scale projects. Without it, developers face more risk. Financing becomes harder. Confidence weakens. And real estate markets are highly psychological. When global investors start pulling back, it sends a signal, not just locally, but internationally, that momentum may be shifting. This doesn't mean foreign investment was the only driver of the boom, but it was one important pillar. Remove a pillar, and the structure becomes less stable. There's also a ripple effect. Luxury markets cool first, then mid-tier markets feel pressure, then broader pricing expectations adjust. When fewer investors compete for properties, bidding wars shrink. Price growth slows. Transaction volume drops. And remember, it's not just about prices. Fewer transactions mean fewer commissions, fewer legal contracts, fewer renovations, fewer related jobs. Foreign investment pullback didn't crash the market on its own, but it reduced fuel at a time when interest rates were already rising. And in a leveraged market, even small shifts in demand can have amplified consequences. Now I want to hear from you in a different way. If you're watching from outside Canada, tell us where you're tuning in from. If you're inside Canada, comment your city and describe what you're seeing. Hot market, cooling fast, or completely frozen? Your comment isn't just engagement. It helps create a real-time map of what's happening across the country. Number 5. Over-leveraged households. Here's a truth that doesn't get enough attention. Canada has one of the highest household debt levels among developed nations. For years, low interest rates made borrowing feel safe. Mortgages grew larger. Lines of credit expanded. Credit cards filled the gaps. As long as home prices kept rising, everything seemed manageable. But leverage is a double-edged sword. When rates were low, debt worked in homeowners' favor. Monthly payments felt predictable. When home values increased, equity built up quickly. Many people felt wealthier on paper, and they spent accordingly. Then interest rates surged. Suddenly, the same level of debt became heavy, very heavy. Variable rate mortgage holders felt it immediately. Those with fixed rates are now bracing for renewal. And it's not just mortgages. Car loans, business loans, and credit lines have also become more expensive. This is where pressure builds quietly. When a household is over-leveraged, even a small financial shock can cause stress. A job loss, a rate hike, a drop in property value. All of it tightens the margin for error. Families start cutting back. Fewer purchases, fewer upgrades, fewer big decisions. And when millions of households pull back, spending at the same time, the broader economy slows. Retailers feel it. Service industries feel it. Small businesses feel it. Housing markets rely on confidence and cash flow. When both weaken, activity slows dramatically. And over-leveraged households don't create headlines overnight. There's no dramatic crash sound. Instead, it's a steady squeeze. Payments rise, savings shrink, flexibility disappears. And in a market where so many stretch their budgets to buy at peak prices, that squeeze can become a serious economic pressure point, especially if unemployment rises alongside higher debt costs. Now let's make this personal. Without sharing anything too private, how to comment one word that describes how you feel about the current economy? Confident, concerned, cautious, optimistic? Your single word says more than you think, and it helps everyone here understand the real mood on the ground. Number 6, declining sales volume. When people hear that housing prices are only down slightly, they assume things aren't that bad. But here's what most headlines don't tell you. In real estate, volume matters more than price. Sales activity is the engine of the housing market. When homes are buying and selling quickly, money flows. Agents earn commissions. Lawyers process contracts. Inspectors, appraisers, movers, stagers, photographers. Everyone stays busy. But when sales volume drops sharply, that entire ecosystem slows down. And that's exactly what's been happening. Fewer buyers are qualifying due to higher interest rates. Sellers are hesitant to list because they don't want to accept lower offers. The result? A frozen standoff. Listings sit longer. Transactions decline. The number of deals closing each month shrinks dramatically. Even if prices haven't crashed, a 30 to 40% drop in transactions can wipe out income for thousands of workers tied to real estate services. Think about it like a shopping mall. Even if store prices stay the same, if foot traffic drops in half, stores struggle. Some close. Staff get laid off. It's the activity that keeps everything alive. And there's a psychological effect too. When fewer homes sell, buyers become cautious. Sellers become defensive. Momentum fades. The excitement that once fueled bidding wars disappears. Declining sales volume doesn't make dramatic headlines every day. It's quieter than price crashes. But economically, it's incredibly powerful. Because when transactions dry up, jobs tied to housing dry up too. And in a country where real estate plays such a large role in GDP, that slowdown can ripple far beyond open houses and sold signs. Now I want you to participate in something simple but powerful. Look around your neighborhood. Are you seeing more "for sale" signs sitting longer? Fewer "sold" stickers? Or is everything still moving fast? Drop your observation in the comments, just a short update from your area. When hundreds of people share what they're seeing locally, we create a real-time national snapshot together. Number 7, investor panic selling. During the housing boom, investors were everywhere. Pre-construction condos sold out in hours. Short-term rental units promised massive cash flow. Social media was filled with stories of people buying their second, third, even fourth property. Real estate wasn't just housing, it became a wealth-building machine in the public mindset. But here's the reality about investors. They move fast when things are rising, and sometimes even faster when things start falling. As interest rates climbed, the math changed. Mortgage payments increased. Rental regulations tightened in some cities. Short-term rental rules became stricter. Suddenly, properties that once generated positive cash flow started bleeding money every month. And investors are typically more sensitive to losses than primary homeowners. If numbers stop making sense, well, they don't wait emotionally. They list the property. When many investors decide to sell around the same time, supply rises quickly. More listings hit the market. Competition increases. Sellers start lowering prices to attract buyers. The downward pressure can accelerate a correction. This creates something powerful: momentum in reverse. During the boom, fear of missing out pushed prices higher. Now, fear of losing money can push listings higher. And remember, investors often own condos and entry-level homes. When those segments weaken, it impacts first-time buyers and the broader market structure. Investor panic selling doesn't need to be dramatic to matter. Even a moderate wave of listings can shift market psychology. Because once the belief that real estate only goes up cracks, everything changes. Let's do something interesting. If you're an investor, comment "investor" below. If you're a homeowner, comment "owner." If you're still... Number 8, immigration versus affordability crisis. On the surface, this seems confusing. Canada continues to welcome record numbers of newcomers each year. Population growth is strong. Cities are expanding. Logically, more people should mean more housing demand and stronger prices. So why does the market feel unstable? Because demand only works when it meets affordability. Yes, more people need places to live. But if home prices and rent levels rise faster than wages, demand becomes strained. And newcomers may rent longer. Families may double up. Young professionals may delay buying altogether. In other words, population growth alone doesn't guarantee market stability. There's also a timing issue. Immigration can increase housing demand quickly, but building new supply takes years. Permits, zoning approvals, construction timelines. When supply can't keep pace, affordability worsens. And when affordability worsens, buyers disappear. This creates a strange imbalance. On one hand, Canada needs more housing. On the other hand, developers are slowing projects because financing is expensive and buyers are cautious. So even with strong population growth, transaction activity can weaken. And here's the deeper issue. If newcomers struggle with high housing costs, their spending power shrinks too. That affects local businesses, services, and overall economic momentum. The result? A housing market caught between strong long-term demand and short-term financial pressure. Immigration is not the problem. Affordability is. And when affordability breaks down, even a growing population can't prevent market turbulence. That tension between population growth and financial reality is one of the most misunderstood forces shaping Canada's housing story right now. Now I want to hear something thoughtful from you. Do you believe housing supply is the main issue? Or is affordability the bigger problem? Comment just one word: supply or affordability. And if you want, add a short explanation. We genuinely read the comments, and your perspectives often shape future videos. We put serious research, time, and creative energy into every breakdown to make sure you get clarity without confusion. Number 9, government policy missteps. When housing prices were skyrocketing, many people demanded action, and governments responded. They introduced stress tests to limit risky borrowing. They applied foreign buyer taxes. They tightened lending rules. They added vacancy taxes. On paper, these policies were designed to cool speculation and protect long-term stability. But here's the difficult truth. Policy timing matters just as much as policy intention. Some of these measures were introduced when the market was already slowing. Others layered on top of rising interest rates, creating a combined pressure effect. Instead of gently cooling the market, the weight of multiple restrictions may have amplified the downturn. Housing markets are incredibly sensitive to confidence. When new rules are announced, uncertainty rises. Buyers hesitate. Investors pause. Developers delay projects until they understand the new landscape. There's also a lag effect. Policies take time to show results. By the time they start working, the market cycle may have already shifted. That's when overcorrections can happen. For example, tighter lending rules may prevent risky borrowing, which is good long-term, but they also reduce the pool of qualified buyers in the short term. Fewer buyers mean lower sales volume. Lower volume means fewer jobs connected to real estate. It becomes a balancing act. Too little regulation can fuel bubbles. So too much regulation during a fragile moment can deepen slowdowns. This isn't about blaming one decision. It's about recognizing that housing markets are complex systems. When interest rates, global pressures, and domestic policies all tighten at the same time, the combined force can feel overwhelming, and sometimes the cure can temporarily feel as painful as the problem. Number 10. Global economic slowdown. Even if Canada fixed every domestic issue overnight, there's one force it cannot control: the global economy. Canada is deeply connected to the world. It relies heavily on exports, commodities, foreign investment, and trade partnerships. When global growth slows, Canada feels it quickly, and right now uncertainty is rising everywhere. Major economies are battling inflation. Central banks across the world have raised interest rates, which businesses are cutting costs. Consumers are spending more cautiously. Global trade growth has weakened compared to the post-pandemic surge. When global confidence drops, investment slows. When investment slows, hiring slows. And when hiring slows, housing demand weakens. Why? Because housing thrives on stability and optimism. People buy homes when they feel secure in their jobs. Investors buy property when they believe growth will continue. Developers build when financing is accessible and demand looks strong. But in a global slowdown, caution replaces confidence. There's another layer too. Canada's economy is closely tied to commodities like oil, gas, and natural resources. If global demand for these weakens, government revenues and corporate profits can shrink. That affects employment levels, which feeds back into housing demand. Housing markets don't operate in isolation. They are part of a much larger economic machine. So when global pressures combine with rising domestic rates, high household debt, investor pullback, and policy tightening, the impact becomes amplified. This is why the current housing shock feels different. It's not just one problem. It's multiple pressures hitting at the same time, locally and globally. And that combination is what makes this moment so powerful and so uncertain. When you step back and connect all the dots, a powerful picture begins to form. This isn't just about falling home prices. It's not just about interest rates. And it's definitely not about one single policy decision. What we're witnessing is the collision of multiple forces at once: rising borrowing costs, mortgage renewal shocks, construction slowdowns, investor pullbacks, heavy household debt, policy tightening, and now global economic uncertainty. Individually, any one of these pressures might have been manageable, but together, they create something much stronger. Housing in Canada became more than shelter over the past decade. It became an investment strategy, a retirement plan, a symbol of financial success. Entire industries expanded around the assumption that real estate would continue climbing. Now that assumption is being tested. The real question isn't just whether prices fall further. The deeper question is whether confidence can stabilize. Because housing runs on psychology as much as economics. When people feel secure, they buy. When they feel uncertain, they wait. And waiting changes everything. At the same time, it's important to stay grounded. Housing markets move in cycles. Booms don't last forever, but neither do downturns. Corrections can create opportunity, resets can restore balance, and long-term fundamentals still matter. So instead of reacting emotionally, the smartest move right now is awareness. Understand the risks, watch the data, protect your financial flexibility. Because whether this becomes a short-term correction or a deeper structural shift, one thing is clear. Canada's housing market has entered a new chapter, and what happens next will shape the economy for years to come.